Good morning from the East Coast and welcome to Fintech at Cornell's webcast, The Future of Payments. My name is Susan Joseph and I'm the Executive Director of the Fintech at Cornell initiative. Fintech is the convergence of financial services and digital innovation, an interdisciplinary field. At the Cornell Fintech Initiative, we are shaping the future of how Fintech shapes business. We've offered webinars over the past year on financial education, the future of money, digital assets and inclusion, and are very excited this morning to offer this webinar on the future of payments. We have a truly esteemed panel today of industry and academic experts, some even are Cornell alums. I will turn the mic over to our wonderful moderator, Leanne Yang. Let's get started.
Thank you very much, Susan, for the introduction. I'm Leanne Yang from University of Toronto. So as Susan said, this is a panel on payment. Payment is a great kind of exciting area, but a lot of new developments in this area in the environment. And recently, a lot of big fintech firms challenge the existing kind of banks, and there are a lot of new developments. And we want to understand what's the relation between those new kind of payment systems between the fintech firms and the bank and the traditional banks. And also some other bigger players, even the regulators like a bank and like a government, they also try to kind of play a role into the CBDC, the central bank digital currency. And they also concern the kind of the privacy issues and how to design better regulation to help us to protect the consumers and improve social welfare, how to shape the IO structure so that the entire payment infrastructure serves the society better. And so in this panel, so we have both kind of great experts from industry and also from academia. So we try to make a lively discussion to think about the deeply what's the current issue, the current disruptions, also opportunities for the kind of the payment environment. And we also try to think about how we can make a contribution to the regulator debate and what will be the kind of the futures of this development. So let's probably the first thing we want to talk about the payment basics, and I want to invite Uday, the kind of professor from Michigan, to kind of help us to understand what are the basics of payments, so what the payment system means and what kind of method we have. So why some countries or regions have particular types of payments, and like China, we have cash and QR, and in the US we have credit card. And what's the kind of basic difference between this different payment system?
Thank you, Leanne. My name is Uday Rajan, and I'm a professor of finance at the University of Michigan. So let's talk about the current state of payments in the world, and then we'll get to the future of payments. Firstly, what are payments? For the purpose of this panel, we're going to think of a payment as a transfer of money between one party and another party. Most commonly, the most common reason why we're transferring money amongst each other is in exchange for some good or service, or maybe a financial asset. And so that's what a payment is. So who makes payment? All of us, everybody in this webinar, anybody in the economy. So all of us in this webinar, all of the institutions and the businesses that we interact with make payments. What are the forms of payments? So for example, the forms of payments, let's start with what is increasingly going to be the past history of payments rather than the future. But let's start with cash. Cash is a form we're all familiar with. It's been an extremely common form of payment in many parts of the world for a long time. Potentially hastened by the COVID era, increasingly we're getting towards cashless and contactless methods of payments. Now, payments do take different forms in some different parts of the world, right? So here in North America, where I am, and where I guess most of the panelists, a lot of the payments we make are based at the very core on bank-to-bank transfers. So for example, when my employer pays me, the direct deposit shows up as an automated clearinghouse or an ACH payment into my bank account. We make wire transfers from one bank account to another. As consumers, I use as a consumer, I use a credit card a lot. At the core of the credit card transaction, the bank of the merchant is receiving a payment from the issuing bank. So if I use sort of Zelle, that again eventually results in a bank-to-bank transfer. Now we're getting a little bit away from that. So for example, when we get to Venmo, yes, we can transfer money from your bank account to Venmo and back. But if you're paying other people on Venmo, you can, directly money going from a Venmo account to a Venmo account without involving the bank. And more now, some of the merchants I use. So for example, when I use a landscape service, the landscape service lets me pay them on Venmo. So we're beginning to sort of bypass the bank guardrails a little bit here. In other parts of the world, it's actually been common to bypass the bank guardrails. For example, think of M-Pesa in Kenya. The reason M-Pesa developed as mobile money was precisely because banks were scarce in many rural parts of Kenya. So it became a device to bypass banks completely. If you think of Alipay in China, again, between your Alipay account and your bank account, you can transfer money back and forth. But once you're within the system, you can transfer money to other people within the system outside the account. And eventually, that's the core of it, right? Well, what is virtual money? It's a number in an electronic account, and provided I can use that to buy goods and services and so on, it might not matter so much whether it's in a bank or not. As we go forward to think of the future of payments, of course, as you all know, people have now been paying using Bitcoin for some things. So perhaps the future of payments belongs on the blockchain using cryptocurrencies, perhaps stable coins. There's been a lot of talk about central bank digital currencies, and so that might show up in the future as well. So that is broadly the landscape of where we've been and where we might be going. And let's see what the rest of the panel now has to add.
Thank you, Uday, for the great description, explanation of the landscape. So maybe I invite Brad to talk about a little bit of what Vast Bank does in reality to kind of add a complement to what Uday just mentioned.
Yeah, so Brad Scrivener, I'm the CEO of Vast Bank, and Susan had mentioned maybe I'm going to be a grandpa here anytime. So my daughter, so maybe that's one fact that wasn't in the bio at least. So we're excited about that. From a banking standpoint, if we think about the things that Uday was talking about, it's very disruptive, right? And just to set background. Vast was the first national bank in the United States to stand up a fiat and a crypto account side by side. Okay, so we did pilot starting in January of 2021. We enabled a fintech in the second quarter of 2022, and then we launched a Vast crypto banking direct product in the third quarter. So we've I guess you could call us pioneers, perhaps, in this particular space, with doing those things. So if you think about what's happened here in the industry and the things that have been going on, it's been extremely, extremely disruptive, right? But this disruptive nature it didn't start with crypto, right? I mean, if you think back into the mid 90s with Blockbuster and with Kodak and all these things, disruption has been going on like crazy. And so when you come up into the Great Recession, a lot of things have happened. You've had customer preferences changes, you got technological changes that are going on. I mean, think about it. The power of what launched people to the moon in our hands with mobile devices. You've got regulatory changes that have come in, new competitors. We're going to talk more about this, but fintech, big tech, Google, Facebook, who's a competitor anymore? So there's been this tremendous implication into financial services where you see a decoupling of the value chain that has been going on. And so what's the impact? Well, we believe that we would agree with Gartner. 80% of financial institutions, heritage financial institutions, were going to be irrelevant by 2028. So what does that mean? You're going to see three types of institutions that continue on and survive. Those that already have scale, those that develop some form of a niche, and those that have some form of digital leadership. Now, clearly, Vast, we're 800 million in assets right now, so we clearly have opted for that digital leadership space. So when you sit here and you think about the impact to customers, there's going to be tremendous positives that take place, just like other disruptions that have happened. You've got greater choice. You got greater control. You should be able to have faster and cheaper. And hopefully, as that technology goes out and enables, you're going to see more people participate in the financial services industry. But, and I assume we'll talk a little bit about this also, you've got pros and you've got cons to everything. So, when you start removing intermediaries that have typically stood in the gap, there's also greater responsibility that now falls directly on the consumers. And so it's up to you to protect your digital identity if you're in a self-custodied wallet. It's up to you to deal with fraud losses. And, make no mistake, there's billions of dollars of fraud losses in the industry that intermediaries protect customers from. So anyway, that's kind of a high-level overview.
Thank you, Brad. Thank you very much for you mentioned a lot of kind of things about disruption and also many opportunities for kind of like financial inclusion to help the consumers. So I think that's great. And maybe I can invite Michelle to. I know Michelle had a lawyer background, so maybe Michelle give us some perspective from a lawyer, from the law perspective.
Sure. Thank you so much for joining us, and thank you to my co-panelists. I'm Michelle Gitlitz. I'm the General Counsel of Flexa Network, Inc. We enable fraud-proof crypto payments at everyday merchants such as Barnes & Noble and Chipotle and Nordstrom. I think to piggyback a little bit on what Brad was saying, we're in for some of us, not so new, but for the majority of people, a new world where consumers demand to be able to purchase and trade and spend their digital assets at more traditional financial institutions, and to use those assets to buy consumer goods. And, from the legal perspective, we have the alphabet soup of regulators who all want to potentially regulate the industry, whether it be the Office of the Comptroller of the Currency, the Securities and Exchange Commission, the CFTC, the IRS, every regulator that I can possibly name on both the state and the federal level wants to make sure that the assets are safe, they're protected, they're not being used for money laundering or terrorist financing, and that you pay your taxes on them. So it's an interesting legal perspective because we don't have a single playbook that we can go to figure out, who our friendly regulator is for which activities. Unfortunately, most of our guidance comes from enforcement, the worst of the worst who have been caught doing something that they shouldn't do. But for the everyday actors who are just trying to run their business, it's challenging.
Thank you, Michelle, for providing this legal perspective. So now maybe I turn to the kind of mic to Sunil. So Sunil is the head of Fintech at the Financial Service. So Sunil may kind of help us to understand what's the disruption and what's kind of pro and cons.
Sure. Thanks, Leanne. Good morning, afternoon, everybody. Sunil Sachdev, head of Fintech here at Fiserv. And fun fact, I guess, is I spent close to half my career overseas working on banking and payment infrastructure outside the U.S. as much as I have in the U.S. So this is definitely a great conversation for me to participate in. So thank you for the invitation. With regards to kind of the disruption we're seeing, I think a lot has to just build off of what Brad and Michelle has said, right? I think we are in a unique time because if you take a broader lens, right, we had so much happening in such a short period. Over the last decade, with the Great Recession, then you got the Great Resignation, then you've got great wealth transfer that's happening where we've got at one time the most amount of money accumulated by a single generation, which is the baby boomer generation, being transferred to Gen X and millennials and Gen Z. And as that is happening, we're in the wake of this, technology renaissance, right? Brad hinted at this with regards to the API economy that we live in and interact with every day. That is really changing behaviors, as Michelle stated, in terms of how people do different types of transactions, and it's really challenged the existing ecosystem to keep up, especially the regulatory environment in terms of what's going on. We're seeing at Fiserv, we did a sample survey recently. We're seeing more funds moving to crypto from ACH transactions happening at financial institutions than we're seeing being spent at Target, Amazon, and Walmart all together, right? And that happened just in a 60-day period earlier this year for a sample of 25 institutions between the size of $1 billion and $11 billion, right, in assets. So when you see that type of revenue leakage or cash leakage from traditional financial institutions into these non-traditional forms of payment, most notably crypto wallets, you start really kind of questioning, hey, what is kind of, as Brad said, the future of all of this? How is this going to unfurl for traditional financial institutions? On top of that, we conducted recent surveys and found that 40% of Gen Z have a different primary financial institution today than they did 2 years ago. And those that changed most recently, 50%, 57% of them will also change their institution in the next year. So the notion of a primary financial institution or the bank that you bank with because your direct deposit goes in there every 2 weeks or every month, that's moving and becoming much more ambiguous, right? People are building personal financial ecosystems around them. The bank is one part of that ecosystem, but again, there's crypto wallets, there's wealth managers like Robinhood, all on the face of your mobile phone, right? So different apps moving money, value, data across, making it very easy for folks to create financial service ecosystems that rely less on having a primary financial institution do everything that you need to do. So lots of disruption, innovation happening, lots of changes in terms of what the next generation expects from financial institutions, which I think, again, kind of underscores what Brad talked about, which is, there's going to be very specific niches now on how and where financial institutions will continue to stay relevant going forward.
Thank you, Sunil. So in our discussion, I see we use the word disruption a lot. So that word might sound a little bit negative. I think this disruption itself is also opportunities, right? Disruption to the current system. So maybe that's probably damaging to the existing banks in some way, but I think probably that also potential collaboration between the banks and the fintech firms. Sunil mentioned that now many kind of consumers move their money from the traditional banks to the crypto, and as consumers, they have their new ecosystem to organize these different payment things. So I want to understand probably as a kind of as researcher, I want to understand what's exactly the kind of the relation we think the traditional banks and the fintech firms. I know Woody recently had a paper studying this one published in RFS, one of the top 3 journals. Maybe I started with Woody for some kind of academic perspective on this topic, the IO structure between the traditional bank and the fintech firms.
Thank you, Leanne. Indeed, it is really exciting to see how quickly this space has evolved, right? With fintech firms often coming and say, think of a firm like Square coming in and competing in the payment space. And then we wake up 5 to 7 years later, and that Square has not only got into lending, but it has acquired a bank. So now Square is a bank. And similarly, we see PayPal had come in as initially as a payments firm, as has now got into the lending business as well. So the space is evolving very rapidly. Brad, I'm going to steal your line, but banks, Brad told us the last time we met that banks do three things. One is they store value, another is they transfer value, which is the payment space, which is really what the bulk of this panel is going to be about. But they also lend value. And the way I see it, well, these functions are going to be required regardless whether we're in the crypto fintech world or not. They were required, 1,000 years ago, they're going to be required way into the future as well. And there's probably a reason why the transfer and the lending got bundled into banks in the form that they're at, which is, so Leon, you kindly referred to my paper. But my paper is about the idea that when we make payments, there's information contained in our payments that's useful to a lender when they want to screen us to see if we're credit worthy. To the extent that information is useful, anybody who has access to that information is better able to screen borrowers. At that point, it kind of makes sense for the lending and the transfer functions to be bundled together. And so even though we saw fintech firms often come in, often they got sort of a foot into the space, if you wish, through the payments function, to the extent they've expanded into lending and they're using the information they have from payments to get into lending. It's entirely possible that 10 years down the road, we'll have institutions, we might or might not choose to call them banks, but they'll be doing many of the same things that banks today do. And one sort of concern that comes out from the regulatory viewpoint is it that through all this disruption, at the end, we'll have taken a bunch of activities going on in the regulated sector and transfer them to an unregulated sector? And then will we have to think of trying to regulate that sector once more? So perhaps we'll wake up with a new kind of institution that does all these functions. We won't call it a bank, we'll call it a fintech something. But to all intents and purposes, at a very high level, it'll be doing all of the things that banks right now are doing.
Thank you, Uday. And Brad, I also like very much your summary of what the banks do: the store value, lend value, and transfer against the value. And as far as I know, in the banking literature, we have many papers studying kind of competition in the lending market, but not many papers on the payment system. And I think it's because of you guys who have done the great things in reality to make this happen. So they give us a lot of interesting and fundamental research questions. I would like to see your perspective on the interaction between the traditional bank and these fintech challengers.
Yeah, that's a great question. I think the right place to start is from the customer's perspective. And from the customer's perspective, I kind of mentioned this earlier. I think it's a good thing that the customer is in control of their experience. Okay. And I think you can look at lots of different industries and you have ranges of customers, from those that want self-service 100% as much as they can, all the way to those that want a very high touch concierge type of approach. Okay. And that's all the way from individuals and institutions or businesses, I think, are on that particular spectrum. So if you sit here and you think about banks and you talk about this value, right? It's customers that determine what is valuable. Okay. It is not what banks determine what is valuable. And you can look throughout history and we won't go through all that in terms of different things that have served for monetary value and all of those type of things, right? But when you start thinking about digital assets, fintech, the traditional banking systems, and how all of that stuff starts coming together, at the end of the day, traditional financial institutions are going to have to figure out how to offer an experience that customers value, okay? And I also think that it is a very big space. And so from my standpoint, if the customer is being served correctly, I don't care if it's through a fintech, because at least in today's world, that sits on top of a chartered institution so that they can have access to the payment system, the ability to transfer some of that value in large cases. But there are also going to be customers that traditional financial institutions are going to be able to serve and to offer an experience that that particular customer group wants to experience. So for me, if you can't tell, I'm all about competition. I believe it's very, very good for customers to be able to, and I think it's good for institutions to be able to compete for those customer bases, and the system should work. So I don't know. That was a pretty broad-ranging answer. Hopefully, that
I like
got
that
into what you're talking about.
That's great. I like the economics perspective. As long as you maximize the consumer welfare, so no matter it's coming from fintech or traditional bank, so that's great. Yeah, I like that's a perspective. And Sunil, so maybe I think I turn the question to you. You can please tell us what the kind of the banks fit in this competition. So what's lacking in the traditional bank? So why the fintech firms become challengers? So why those things the traditional banks cannot do? So what niche do the fintech firms fit in that competition?
Yeah. No, that's a great question. Thanks, Leanne. So I think, our perspective here is that, fintechs really do provide capability of service that allows customers to feel much more engaged in whatever financial transaction or exchange of value that they're trying to complete, right? Fintechs have basically leveraged personalization much greater in terms of the digital experience than financial institutions ever have. So if you look at financial institutions, there's one DDA account, which is a demand deposit account. There's one savings account, right? There's a CD, there's a money market, and that checking account is for everybody, right? But today we have, because of fintechs, they've created workflows and journeys that deliver value to very niche segments of the population from a socio-demographic perspective, right? Whether you're unbanked, underbanked, you have a barber shop, you have you're recently married, there is a financial services application created by a fintech just for you. And behind all of these financial service applications is a sponsor institution, right? And that sponsor institution is required based on the regulatory framework we live in today. So for us, from where we see opportunity is for greater collaboration. We believe that given the current regulatory framework, every financial institution should have a similar perspective to what Brad has, right? It's about working and engaging with technology firms that are offering very unique experiences to segments of the population that financial institution cares about, right? And the financial institution can save lots of R&D funds and tech funds by just partnering with these fintechs and allowing them to engage that last mile, but always the money and the funding and the customer relationship can be shared with that financial institution on their balance sheet. And that way, I think the financial institution wins because their balance sheet is protected. They also get a little bit of a halo effect partnering with some of these fintechs. So they're seen as an institution that is forward-leaning, right? And the fintechs also win because without a sponsor institution behind them, they can't offer the full range of capabilities that they talked about, right? They can only start with a certain niche product and not extend out. Now, the main compromise comes in is from who builds the relationship with which brand for the customer, right? And in this case, the fintech is obviously going to be the brand that is engaging with that customer, and the bank is more of a processor type of relationship in that sponsor scenario. So what we're seeing emerge over the next couple of years is tighter collaboration, right? Now that could change based on regulatory changes, but I don't think that'll happen. Community institutions in this country are far too valuable for the communities that they serve. They really do drive greater benefit to the surrounding community, and a healthy community bank network is critical for the health of the economy in the United States.
Thank you, Sunil. So you mentioned the kind of the collaboration between fintech firms and the traditional institutions. So maybe let me phrase that question a little bit differently and turn the question to Michelle. So in other words, so I'm thinking about so why the traditional banks cannot do things that the fintech firms do, or even the traditional banks, why not the traditional banks acquire the fintech firm and make the fintech firms become a branch of their of the bigger banks. So that's kind of more kind of integrated collaboration. Basically, so these two identities become one identity. So what do you think? What's the friction that prevent this kind of things happening in reality?
Well, I think in fintech, you see some innovative products. And I think oftentimes it's easier to either partner or purchase the fintech that had developed the product line that the bank or the traditional financial services institution is looking to supplement its own products and offerings. I think it oftentimes takes less time to purchase than to build it internally. And so I think what you're seeing banks and more traditional financial institutions reach out to answer the demand from their own customers by partnering with vendors or purchasing these fintechs or their applications for the bank or financial institution's own use.
Thank you, Michelle. So that great discussion about the competition between banks and fintech firms. So forward me a lot of questions from the audience. So maybe let me pick up some questions and to forward those questions to panelists. So one question saying that considering this is from Jeffrey Jack. So considering the present global geopolitical climate, do you think people will start keeping higher amount of cash? And how will that affect other virtual forms of money transfers? You think about cash is safer. There's another question related to this from Tobin, asking so whether kind of the privacy issue. So what's kind of could the panel discuss the intersection of data privacy and electronic payment? So I think these two questions probably related. So about the cash and also kind of privacy. So maybe let me start the question with Brad. Maybe Brad had some perspective on this. Whether we want to use more cash given the current situation, and also what's the kind of the relation between privacy and the payment. What's your thought on this?
Man, those are really good questions. I wish I could hear the other panelists' answers first. How about that? On the privacy side, I do think that is, so I'm going to take the second one I'll let somebody else address the cash side of it. I do think, and this goes back to what Uday was saying in terms of the data that is available in payment streams or in other forms of pieces. So from my perspective, and not every financial institution has this perspective, I believe that the data that your personal data is yours, that there is a contract between the financial institution and the customer, and that is sacrosanct. And we should not be using your personal data to go enrich ourselves and sell it to other places. And go look at your info, your contracts and things like that. And there are financial institutions that are collecting that and using it as a revenue stream. I do not believe that it ought to be done like that. The farthest that I would be willing to go on that privacy side is to work with the customer so that if they wanted to also profit from that sale of that data, if it was aggregated or whatever, that you could have a joint revenue stream. So again, going to your customer, not, in my opinion, taking advantage of that. Now, I think we'll talk, or we probably should, but blockchain and privacy and how all of those things work, that's a very interesting topic, but I won't go down that rabbit hole right now.
Thank you, Brad. So Michelle, I think probably this question is related to that privacy. I would like to have your opinion. So this question is about, so I don't like being tracked and profiled by marketers. So I use cash a lot. It's kind of related to the previous question. So keep privacy. So is there any future kind of payment system in which I can continue to use, but at the same time to avoid bigger data analysis of who I am? So they have the high demand for crypto-based payments. So I want to have your perspective on this question.
Sure. So I think that I think it's an interesting question, and on one end of the spectrum, you see people who want complete contactless payments. They don't want to touch any cash, right? And on the other end of the spectrum, you see people who only want cash. At Flexa, what we do, which may be a potential solution, is when a customer is going to the merchant, say that you're going to Chipotle to buy your burrito, you receive a short-term QR code that allows you to spend a certain amount of money at that vendor. And once you spend that money, that QR code is canceled. It doesn't exist anymore. It's the closest thing that I could think of in a non-cash system. The credit card data survives. It's on your statement. You're in the credit card network. But if you're just doing a one-time transaction and that barcode no longer exists after you walk out of Chipotle with the burrito, perhaps that would give some comfort from the privacy front.
Thank you, Michelle. That's a great suggestion. So Uday, I know you have done a lot of research on this cash and privacy. Maybe you make some comments on those questions, related questions.
Yeah, I just had a quick comment on whether in these sort of uncertain geopolitical times we're all likely to switch back towards cash. I think as consumers, and especially for somebody as old as I am, where when I was young, cash was all I used. It's very normal to think of cash as being sort of the safe asset. But I think we also have to remember that by far the bulk of payments that go on in the economy are business to business payments. Sure, if I need to make payments, for many payments I can use cash. It's not clear to me I can make my mortgage payment in cash, but many of the other payments I'm using are in cash. But my employer, the University of Michigan, cannot handle that volume of cash. There's just no way. So for business to business payments, we're always going to need sort of a non-cash alternative. And I think some of the developments Michelle is talking about really interesting. And I think that is the future of digital payments. We're going to need digital payments for businesses. As consumers, we will be using more and more digital payments. I think we're going to need digital payments that preserve privacy. And Michelle's example of this one-time QR code is a really nice way to think about it. I know QR codes are very commonly used for payments in other parts of the world. They're beginning to be used now in the US. I see on Square and PayPal, you can pay using a QR code. That might or might not be one time. I don't know if it's the same technology that Michelle mentioned, but we're going to need to find some private form of digital payment rather than cash that we can resort to.
Thank you, Uday. So we have a lot of great discussion on this privacy. So maybe Sunil, you can have some final comments on this one, on the privacy and cash payments.
Sure. So I think just taking the geopolitical piece, I think, maybe one of the questions is related to the fact that as part of the economic sanctions that the U.S. and the West applied to Russia recently was ensuring that Visa, MasterCard, and SWIFT no longer work there, right? in certain forms. So I think one of the things that you'll start seeing on this, and you've already started to see this with Russia pivoting more recently and creating their own type of wire or cross-border SWIFT network called the RPS, I believe. So what's going to happen as an unintended consequence of some effective sanctions to Russia is, I think a lot of people are going to recognize that the power the West has to control flow of funds in and out of countries, whether you're commercial or you're doing that through a consumer offering from Visa, MasterCard. So that's one piece. On the blockchain side or the privacy side, again, we're seeing more and more use cases come up, on the blockchain piece. And that's partly because when you look at some of the fintechs today and the work that Plaid and others do by screen scraping or getting access to consumer data to fulfill a very basic request and then use that data to monetize different types of transactions for themselves, I think that's the piece that's heart of the privacy question, right? And Brad alluded to it a little bit. The big banks have looked at different ways to kind of stem the flow of information from their back offices into fintechs who are looking to monetize that further. I think over the next couple of months, you'll start seeing more and more regulatory moves in this direction as well. You started with the CCPA last year, which is the Privacy Act in California. You're going to see more states adopt different types of privacy regulations to ensure that whether you're a financial institution or a fintech, there's only so much that you can do with the data that you get access to.
Thank you, Sunil. So, discussion, you mentioned the regulation, like you mentioned the California law and also the kind of in Europe, the GDPR, they have kind of different, those laws seem to have a different kind of rationales. So like the GDPR will give the consumers the right, the data right. And also, I think probably there's some potential collaboration among regulation bodies within the country or across different countries to think about how to collaborate, to think about the privacy protection. So maybe I think this might be a great kind of opportunity to discuss this issue about the regulation. I know also Udi had papers on this and talking about the private regulation and how in your RFS paper and also your JEF papers on this payment. So do you want to share something about this regulation on the kind of the IO on the banks and also probably related to the previous privacy issue, the regulation?
Just following up on the comments that many of the panelists have made, I think there's clearly going to be some tension between the idea that digital payments are so convenient for us all to use, and so the convenience factor is going to drive us towards using digital payments more and more. On the other hand, with digital payments, there is a digital record of all that I've done, and therefore potentially there's serious privacy concerns that if somebody gets access to that record, you can find my entire history of payments, and there might well be things in there that I don't want the whole world to know about. So there's a potential conflict between these two, and I'm very interested in seeing how that conflict will be resolved. We don't yet know what form that resolution will take. Exactly as you said, Leon, the spirit of GDPR is that the consumer should own their own data. We don't know to the extent to which it can be hacked, for example. I know it's somewhat scary now, the way we use technology. Our phones are always listening to us. The other day, I said to my spouse, hey, maybe we should buy a printer. I just said it. I didn't do anything else. The next time I go online, Google is showing me ads for printers. So there's a sense in which it almost feels like a violation of privacy. At this point, my phone is listening to me. But once we have a complete digital record, privacy concerns are greater. GDPR allows, I guess, penalties for people who will violate that when consumers own their data, and maybe that's the way we'll have to rely on the legal system to enforce these penalties. But that concern is something that for now is certainly a big factor as we think of how this space will evolve.
Thank you, Udi. I think also another important element, in addition to privacy protection, for the regulation, is about the kind of crime, and about the fraud. So maybe so Michelle can please tell us kind of what's the kind of the talk about the fraud issue, the money laundering this issue in the existing system, and how the fraud can be avoided in the newer systems.
Sure. So, coming from a payments perspective, the credit card rails and system were developed, 40, 50 years ago. And so one of the reasons why you see a lot of fraud and chargebacks in the system is because the system itself was not developed with today's usage in mind. And so you're dealing with a lot of plug and plays. There's a lot of different parties that need to be involved for you to actually, for the consumer to actually use their credit card at a merchant. What we've done at Flexa is to create new payment rails using blockchain. And when you use blockchain, you don't need to worry about chargebacks, because the charge is essentially immutable because it's recorded on the blockchain. There's no fraud because the transaction's verified. We make sure that the consumer has the funds to purchase, let's say, the burrito at Chipotle. I'm really using my burrito today, to purchase enough funds in their crypto wallet converted into US dollar to purchase the burrito. They've been onboarded, and there's been anti-money laundering, know your customer checks to make sure that the customer is not on, a restricted list. And then from the merchant's perspective, the merchant gets to scan a QR code, and that QR code is a payment instrument. It is a promise to ensure that the merchant receives their money. And the merchant's also been onboarded with anti-money laundering, know your customer checks. So on both sides of the transaction, you know that you're dealing with parties who are not on any restricted lists. You know that the consumer has enough money to pay for the burrito, and the merchant knows that it's going to get its money. And you have a level of consumer freedom that you don't have with the credit cards. The credit cards are building, integrations to make the consumer feel as if they're spending crypto. But there's a lot that goes in the back end of those technologies to facilitate those transactions. So hopefully I've made that sort of ecosystem a little bit clearer.
Great. So Brad, do you want to have some comment on this issue, on this and the fraud and the money laundering?
Yeah, I'll just say generically, I am constantly amazed at the creativity of the fraudsters that goes on. It's a constant battle, and I think of one of our customer service people just this Friday working with an 87-year-old that we had frozen an account because there were some issues, and she's on the phone, adamant that she has no mobile device, has nothing at all, but yet we're seeing this activity, yet she's adamant that there's no fraud that's taking place. So, for those in the audience, get your alerts, do all that kind of stuff. Fraud's alive and well. We see it on the bank side and the tech side, constantly. But I do think, to Michelle's point earlier, that if you think about that existing regulatory rails and what they do, okay, you typically have had two financial institutions that are regulated, highly regulated on either side of that, coming into and gaining access to the ability to transfer funds, okay? So when you talk about blockchain, or you talk about self-custody wallets or other types of things, one of the things that they're very concerned about is systemic risk to the financial system as how do you give access to the financial service system and the ability to transfer that? And it seems like that regulators are, to their credit, they are trying to figure it out. I mean, they realize that this demand is here, customers want it, and they are trying to figure it out. But it is difficult. This is like a square peg in a round hole, type situation. Decentralized Bitcoin was a decentralized digital currency, right? It was built to have two parties that didn't need to know each other have the ability to trust each other through cryptography, right? Well, now all of a sudden, whenever you're from a regulatory standpoint, how many hops do you go back on the blockchain to determine, where that money came from and who's there? Now, Michelle has a very creative solution. So, with that, I'm just saying that there are real challenges. How do you deal with elder abuse if someone steals identity on the blockchain and one of those transactions take place? In the back end, in the traditional world, you have financial institutions working together to repair that, or to mitigate against those things. So, it's a really, really complicated thing, and I'm probably not qualified to answer it all.
That's a great insight. Thank you very much, Brad. The time really flies. Chris just alerted me that only 10 minutes left. We still have a lot of questions, probably topics that we want to cover. So one important things I want to talk about is the CBDC, the central bank digital currency. So many kind of central banks are considering this CBDC projects. I think China had already launched its own CBDC, and Bank of Canada is also considering it. So probably I want to start with this is also important for the monetary policy, not only for the kind of convenience of this kind of privacy. The discussion is also for the government, the stability. Everything is relevant. So maybe I started with Sunil to probably talk about what the CBDC is. This is basic concept. What's your perspective on this?
Sure, thanks, Leanne. So, for CBDC, we've been tracking it closely. I know we've seen the Biden administration come out most recently with executive orders asking a number of institutions and the government to come up in the next 60, 90, 180 days with a plan around CBDC. At a very high level, I think it's exactly what you said, Leanne. It's as more and more transactions become digitized, it becomes incumbent on the regulatory institutions to manage how much of that currency is in the public domain, and to ensure that the value of that currency does not get marginalized as it changes from a physical form into a digital form at a very high level. And also with the U.S. With the U.S. dollar becoming or as the U.S. dollar is the currency of choice in many transactions around the world, not just in the U.S. It's an important leadership position for the country, and I think that's what kind of is creating some apprehension given where China is and what they're looking to do as well, right? So there's a lot of things to be considered as you think about CBDC. One is, how do you manage the flow of funds? How do you kind of balance out, the reality of blockchain and being more towards a decentralized type of activity than a centralized activity, and trying to kind of create a holding area to manage all of those transactions to ensure there's some remediation for fraud and other things that happen in the world today. So it is an evolving space. I think it's one that the U.S. really needs to stay on top of. I was encouraged by some of the recent papers that came out of the regulators around stablecoin recently, allowing that and the market to kind of figure that out themselves, making sure that there's a certain amount of reserves, 1-for-1 ideally, for stable coins that are minted out in the marketplace. So we're going to see this story kind of evolve. We're in the early innings of CBDC, but I think it's really important that the U.S. plays a leading thought leadership role in terms of how these things will play out over the next couple of years.
Thank you, Sunil, for the great summary. And also, you alluded that if kind of if the U.S. does not launch this CBDC, that might affect the U.S. dollar leadership. So I want to turn this question to Uday to ask, so what's your view on kind of general implications of CBDC for monetary policy? And if the U.S. does not launch a CBDC, if the digital euro, digital China yuan, so what will be the implication for U.S.?
That's a very broad question, Leon. Since we're almost out of time, I'll keep my answer relatively brief, which is, I think, look, there's a demand for digital methods for paying for cross-border transactions. There is this demand for it. You know, all of you would remember what was it, about 2 years ago, Facebook had the idea of a Libra that would be a cross-border currency. And I think when Facebook proposed it, that was the time when a lot of central banks woke up and said, hey, wait a minute. If they're going to be digital cross-border payment methods, they should be running through the banking system rather than on Facebook. And at that point, to the extent that demand is there, somebody is going to fulfill that demand in the long term. I think exactly as Sunil said, the US benefits a lot from the dollar being the currency of the world as of now. If the US does not have a digital dollar out relatively soon, how soon is soon? I don't know, the next 5 to 10 years, some other currency is going to come in and fill that void. And it's quite possible that the US will lose its place of primacy there.
Great. So we only have 4 minutes. So maybe I ask each panelist and the view, what's your view on the futures of payment? So maybe I start with Brad. So half of 1 minute.
Yeah. Thanks to all, and thanks for having us. You know, the future, I think digital assets are going to move into that storing value, transferring value, lending value. So everything we're doing roadmap wise is to prepare for customers to have choice and to be able to transfer that value, treat that value the way that they would any other currency with it. So for us, that's the direction. And for us, it's about customer choice, and customers have chosen they want to use this. And now it's up to us to really solidify and think about these things and the new technologies that are coming on to be able to do it faster and cheaper and to include more into the system.
Thank you, Brad. Michelle?
Yeah, I'm going to piggyback on what Brad said, and I'm also going to put a finer point on digital assets versus cryptocurrency. When I think about cryptocurrency, I think about just a medium of value that I'm using for payment, like the Ethereums and the Bitcoins. When Brad says digital assets, I think about and consumer choice. I think about a consumer's ability to spend any digital asset, meaning any cryptocurrency, any loyalty point, any reward point at any merchant, online or in store in any country seamlessly. That is our goal, and to do it in a safe, regulatory compliant manner. That's what I see the future of payments.
Thank you. That's a very ambitious and benevolent goal. Thank you. Sunil, so what's your perspective on the futures of payment?
I think the future of payment is in the early innings. So I would be hesitant to say where I think this will lead. The one thing I will share is that I don't think that the book is completely finished on community financial institutions and the role that they play in the United States. I think there's a lot of opportunity here for community institutions to evolve, much like Vast Bank, and basically work to provide, to create, I should say, their next leg of innovation that will keep them relevant with the customers they have today and the next generation of customers that are coming.
Thank you, Sunil. Uday, Please, you can summarize. Yeah.
Just one line, where for sure the future of payment is going to be more digital. That's the space we're moving into. I'll just speculate a little bit. Michelle made the distinction between digital assets and cryptocurrencies. I'll just speculate here a little bit and say it will be more digital. It does not have to be blockchain based. Not clear to me blockchain is the most efficient way to make payments on a large scale. And finally, I think we have far too many cryptocurrencies now, and I think we'll see a consolidation of cryptocurrencies in the years to come. All I'm forecasting wildly, and maybe I'll be wrong in all of those, but that's my forecast.
Thank you very much. Thank you, everyone. This is a great hour. It's a very thought-provoking discussion, very deep discussion. I learned a lot. Thank you very much. It's 12 p.m. I think that's the end of the panel. Thank you very much. Thank you, everyone.
Thank you.